Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate filings. And no, this report is not about fluffy kittens taking over Wall Street, but it does mention a lot of shares and warrants, so just maybe there is a wild ride ahead. Today we're diving into a filing from Safeguard Acquisition Corp. Now you might not have heard of them, and that is pretty normal for a company that is just getting its feet wet in the public market. This report is essentially their coming out party confirming the details of their initial public offering or IPO. Think of it as the official announcement after the big event. It tells us exactly what they sold, how much money they raised, and who is now on board to run the show. So what happened? They went public, sold a bunch of units, which are like packages of shares and warrants, and now they've got the funds to go find a business to buy and merge with. This is a common strategy for what are called special purpose acquisition companies or SPACs. So let's break down what Safeguard Acquisition Corp actually did. They had an IPO and sold what they call units. Now, these units are not just simple shares. Each unit was made up of one Class A ordinary share and half of a redeemable warrant. What is a warrant, you ask? Basically, it is a ticket that gives its holder the right to buy a company's stock at a particular price in the future. Each whole warrant lets you buy one Class A ordinary share for $11.50. They managed to sell 23 million of these units, and get this, even sold an extra 3 million units, because the underwriters exercised their option to buy more. That is a lot of units, and that means a lot of money raised. And how much cash did they rake in? They sold each of these units for $10 a pop. Multiply that by the 23 million units and you get a cool $230 million. That is a significant amount of capital for a company looking to make an acquisition. This money is now sitting there, waiting to be used to buy another company. Of course, an IPO isn't just a handshake. There are a whole lot of agreements that get signed. We see here they signed an underwriting agreement with Jefferies LLC. This is pretty standard. Jefferies basically helped them sell all those shares and units to investors. They also signed a warrant agreement with Continental Stock Transfer and Trust Company, who will act as the warrant agent, making sure everything is handled correctly when those warrants are eventually exercised. You also see agreements with their executives, directors, and their sponsor Safeguard Acquisition Management LLC. The sponsor is typically the entity that initially formed the SPAC and often gets founder shares. This letter agreement is important because it lays out the terms for the company's leaders and its sponsor. It usually covers things like how long they'll stay with the company, any restrictions on selling their shares, and their commitment to the company's goals. It is a way to align everyone's interests. Another key deal is the private placement units purchase agreement. This is where the sponsor and the underwriters themselves bought additional units directly from the company before the public offering. It is a way to show commitment and confidence in the deal. In this case, the sponsor bought 470,000 of these private placement units, and Jefferies bought another 230,000. These are essentially the same units sold to the public, but bought directly from the company. Now let's talk about who is actually steering the ship. The filing mentions the appointment of 4 new directors: Dan Crowley, Bruce Carlson, Richard Newton, and Lee Stern. These folks are all considered independent directors, which is generally a good sign for corporate governance. They're not tied to the company's management in a way that might create conflicts of interest. It also details the board's committee assignments, with Carlson and Crowley heading up the audit committee and Stern chairing the compensation committee. These committees play a crucial role in overseeing the company's financial reporting and executive pay. These new directors are not just getting paid in cash, they've also been granted a significant number of Class B ordinary shares. This is another way to align their interests with the company's long-term success. When directors hold shares, they have a direct stake in how well the company performs. It is a common practice to give directors a mix of cash compensation and stock ownership. So what happens to all that money from the IPO? Well, a big chunk of it, $230 million to be exact, along with some deferred commissions, has been placed into a US-based trust account. This trust account is managed by Continental, the same company that is acting as the warrant agent. This is a pretty standard setup for SPACs. The money in this trust account is essentially ring-fenced. It can't be touched by the company for anything other than finding and completing a business combination, which is their primary goal. They can only use a very small amount of the interest earned to cover tax expenses and liquidation costs. Otherwise, the funds are meant to be for acquiring another business. If they can't find a suitable business within a certain time frame, usually 24 months, the money is supposed to be returned to the shareholders. Finally, the filing also serves as a confirmation of 2 press releases. One announces the pricing of the IPO, which means they set the final price for their shares and units. The other announces the actual closing of the IPO the moment they officially became a publicly traded company. This is all standard procedure for companies going public. Now let's get down to what this all means. Safeguard Acquisition Corp has successfully raised a large sum of money with the intention of acquiring another business. The structure of the deal with units and warrants is designed to attract investors while giving the company flexibility. The management team and board seem to be in place with independent directors to ensure good governance. The funds are secured in a trust account, which is a positive signal that they are committed to the acquisition goal and protecting investor capital. However, the biggest risk for any SPAC is finding the right target company and successfully completing a merger. The success of Safeguard Acquisition Corp will entirely depend on the quality of the business they choose to acquire and how effectively they integrate it. The warrant structure also means that if the company performs well and its stock price rises above the warrant exercise price, it could lead to dilution for existing shareholders. In conclusion, Safeguard Acquisition Corp has completed a crucial first step by going public and raising substantial capital. The path ahead is about executing their acquisition strategy. They've set the stage, and now the real work of building a business begins. It is a high-stakes game, and the next few years will tell if they can deliver on their promise. Alright? That is our breakdown of Safeguard Acquisition Corp's latest filing. What is your take on SPACs and their role in the market? Do you think this company will be successful in finding a good acquisition target? Drop your thoughts in the comments below. If you found this analysis valuable, hitting that like button really helps us out, and make sure you subscribe for more deep dives into corporate filings. And if you want to chat with us and other finance enthusiasts about these reports, join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.